Hi guys, this is going to be a little bit of a different video, and I'd like to start it off with a quote. Every Tesla investor could be described as a Tesla speculator. Tesla certainly doesn't have the earnings nor the assets to justify $2,000 a share now. The price of Tesla is determined exclusively by what it might be worth in the future. At first, it was very optimistic 2-year price targets, then it becomes 5-year irrational expectations, and then the price is determined by ludicrous dreams that will take well over a decade to achieve. Now, what if I told you that quote was from 1999, and what it really looked like was this? While researching my last video about the first investors to understand Amazon's potential, I read through a lot of message board debates, and since I have the benefit of over 20 years of hindsight, I knew who was right. Want to see a crazy thread? How about this one titled Blockbuster versus Amazon? It's started by an Amazon bear, and since it's 1998, he's not saying that Amazon is going to be the next blockbuster, meaning that it will soon be bankrupt. He's chastising an Amazon bull for saying Amazon is similar to Blockbuster, while in his words, quote, "Nobody was in the home video rental business before Blockbuster, but plenty of companies have been in the book business before Amazon. This is not a brave new industry as you originally claimed." Wrap your head around that. Then, after reading through hundreds of messages, sometimes seeing great points met with aggressive, condescending, and ultimately absolutely wrong rebuttals, I had a realization. I might be one of the Amazon bears. See, I'm a Tesla skeptic, and I've got a couple $100 in losses from shorting between $500 and $700 to prove it. And while not part of the larger TSLAQ community featured in Bloomberg, I'm familiar with and sympathetic to a lot of their arguments. Now, let's look at a few of the core arguments made against Amazon in the late 1990s and see if they sound familiar. Number 1, Amazon is just a bookseller. The bear argument begins at this fundamental truth. Consequently, financial analysis cannot hope to build an accurate picture of the company. They suggest that share price doesn't make sense because Amazon would have to capture basically the entire book market, which itself would have to undergo significant growth. This is despite the fact that Amazon had begun to sell CDs already, they were close to selling videos, and they had mentioned selling software. Obviously, the modern parallel to this is Tesla being merely a car company. If they are, then the legs would be cut out from under the bull argument, which maintains that Tesla is a technology company. And similar to how Amazon had CDs, Tesla has already begun to diversify. The solar roofs are finally beginning their installations, and the company at least has a chance of being the winner in the race to full self-driving. Number 2, deep-pocketed competitors will catch up. Regardless to what type of company Amazon and Tesla should have been categorized as, there's no disputing what their core product was early on. Amazon sold books, and Tesla sells cars. Those products need to do well for the companies to ever get to the later stages where they can realize their final forms. People had their doubts that this would happen. Most bears on Amazon acknowledged that it won the race to market, but argued anyone could sell books on the internet. Online-only competitors sprung up like weeds almost immediately, and Borders and Barnes & Noble weren't too far behind. Here's literally the first post on the Amazon message board after post number 1, which was just announcing the creation of the board. Since it appears that Barnes & Noble is giving Amazon a run for its money by ramping up quickly with the help of Microsoft, Hewlett-Packard, and Firefly Software, do you think the largest bookseller on Earth will meet Goliath's challenge? The expectation was that Amazon's growth potential would be quickly curtailed. These comments sound exactly like those Tesla receives about the electric car market. Any car maker can build an electric car. There's a new Tesla killer coming out every few months, from the Taycan to the e-tron to the Polestar. I have a feeling that more than a few of the old guard companies might be going the way of Borders before this is all over. Number 3, they can't earn a profit. The income statement is another battlefield. Amazon is certainly selling a lot of books, but it doesn't seem like they're ever going to make any money. Growth doesn't count if there's no path to profitability, or, as a bear beautifully summarizes via a quote from Voltaire, which he then translates, "My friend," said the preacher, "do you believe that the Pope is the Antichrist?" "I've never heard that said before," answered Candide, "but whether he is or he isn't, I don't have any bread." Whether Amazon is just a bookseller or not doesn't matter. What matters is that they are losing money doing whatever it is that they do. Tesla has fought and is still fighting to answer this question as well. They recently turned in their fourth consecutive quarter of profits in a row, but bears are still hanging on to the fact that the company is generating a positive net income via the sale of carbon credits, which they argue doesn't really count. Number 4. The valuation is too damn high. One of the most heartbreaking posts on Amazon I came upon was this one, where the poster says, "I agree, you have to look at Amazon as a growth technology company and compare it, not to the other booksellers. Having said that, I'm short at 57, and here's why. Numbers." This guy seems to get it, but he can't get past how preposterous the numbers seem to be. You see valuation throughout the discussion used as a sort of trump card. Even if they dominate books, even if they can turn a profit, even if they dominate all other categories as well and turn profit in those. There's no way the market cap makes sense. The same argument is consistently applied to Tesla today. With a market cap closing in on $400 billion, if they're a car company, then they're the most valuable car company in the world. But even if they're a technology company, they're still one of the 20 largest companies of any type. Where is that value going to come from? Fund manager Cathie Wood famously has a model and a bull case price target that says Tesla is a steal even at today's size. In the past, I would have said she's been right, but added, so far. But now, should I believe her now that I've seen myself thinking just like all of the Amazon bears from 20 years ago? I'm not ready to do that just yet. There's obviously an element of survivorship bias to this analysis. Most companies faced similar criticism in 1999 and then were out of business a few years later. Also, as people are fond of saying, history doesn't repeat itself, but it often rhymes. Amazon was facing these criticisms when its market cap was a fraction of that of Tesla today. Even adjusted for inflation, Amazon peaked at under $50 billion during the height of the dot-com boom. That's only about an eighth of Tesla. The arguments required to justify valuation are then that much harder to make. While I hope most of this video has allowed other Tesla skeptics to have the perspective shifting experience that I did, I wanted to end with another passage I found, this one for Tesla bulls. It's not an argument for shorting or selling, rather a call to constantly be scrutinizing the thesis for holding any stock in your portfolio. Yes, it's being said about Amazon, but remember, Amazon fell about 90% shortly after and took close to a decade to regain its previous highs. I have always said, give me a market cap and I will tell you a story or give you the spreadsheet to justify it. That is a fairly simple exercise, as many have proven right here. It can be done for almost any security, especially when the internet is involved. But here is where I have a problem. There is a name for this, and it's not due diligence. It's called rationalization. As an investment style, this only works when enough other people share the imagination and hop on board. It becomes a self-fulfilling and self-propelling phenomenon. Until the imaginative future comes to fruition, this is all you have. Without stepping in front of this particular train, I would say that this is a terrible investment style to rely on in the long term. The worst aspect of this investment approach is that it leads people to become emotionally attached to their investments. They got in because of rationalization and will continue to rationalize right down to the wire. They will defend the company at any chance because it is their imagination that is coming under criticism. Do with that what you will. Thanks for watching, guys.